Good afternoon. Thanks everybody for joining us. My name is Alyssa Doroff. I'm the cyber technical leader here at NFP based in New York City. I'm very pleased to have three practitioners from Baker Tilly's Global Forensics and Litigation Services practice with us. Bernard Regan, Simon Oddy, and Harriet Bateman, who will share their insights on data recovery expenses and calculating business income loss under cyber liability policies. For those of you who may not know, Baker Tilly is a leading accounting and advisory firm that also has a consulting practice. They routinely work along companies and insurance providers to help determine actual business interruption loss after a cyber incident. I've had the pleasure of working with Baker Tilly throughout my tenure in the cyber insurance industry and can personally speak to their responsiveness and efficacy. Before we get started, just a quick note on logistics. We'll have Simon, Bernard, and Harriet speak for about 45 minutes or so. Upon conclusion of their presentation, we'll take your questions and wrap up. So with that, I'm going to kick it over to Simon so he can get started.
Thanks very much. Thank you for the invite for us to be here today, Alyssa. We appreciate the opportunity. Myself, my colleagues, we're gonna talk today and put some focus on the cybersecurity insurance market. Talk about the process, talk about the claims, talk about that data recovery expense and business income loss coverage. The objectives today really are to have the audience go away with just a better understanding of how that works and the realities of what a claim process might look like. We'll probably touch on some of the challenges, obviously some of the benefits of having that insurance policy in place and how it operates and how it works. So that's our objective. As we've said, we'll take some questions at the end, and if we can wait until the end on questions, that would be great. I think it keeps things on track. And equally, what I would say is if you have questions that we don't quite get to, we're more than happy to field those, via email after the event. So we'll do our best to answer all those questions at some point. If it's not today, then certainly in the future as a follow-up. Just a little bit, really, just to flash through Baker Tilly and who we are. Harriet, if you want to move the slide. Oh, there's a note. Obviously, there's some opinions that we'll give here. These are opinions for the purposes of discussion. They are not going to be, decisions in any way to give you indication on coverage of any existing claim or future claims. So obviously keep that in mind, bit of a disclaimer to kick things off. Really quickly, Baker Tilly, if you've heard of a firm called RGL Forensics, which is where the three of us started our careers, we merged into Baker Tilly about 2 years ago now. And the three of us, are part of a global forensics practice, and we've spent our careers really focused on damages analysis across many insurance sectors and non-insurance damages as well, litigation, etc. So we're now part of a much bigger organization, and that's brought just a tremendous change for us, and just really a change in terms of the resources that we can deploy for our own work, and then we can assist other groups within the organization. So it's a traditional setup as far as an accounting consulting firm. Currently, we're split about a third on assurance and audit, tax and advisory work. And as has been pointed out, we form part of that advisory consulting group. So today, what we're going to focus on, if you can move the slide on, Harriet, thank you. We're going to break it down into really simplifying it into three parts today. We're going to talk about data recovery, the sort of recovery effort needed after a security event, cyber security event. We'll then go into part two, which will focus on the business income loss. It's an area that certainly, and Harriet will talk in detail about that, but it's an area that we've seen grow over the last 5 or 6 years in terms of people's awareness, the availability of that cover on the market, and the complexities of that. So part of our objective today is to really dig into that a little bit. It's very easy to get lost in the weeds, so we'll try and avoid doing that. But I think if we can come away with you having, increased your knowledge of what business income loss looks like and how that might be measured, then I think we'll have done our job. And then part three, we'll talk at the end, really just sharing some claims experience, not war stories as such, but more things that we've seen really over the last 5 to 10 years where we think there's some opportunity for changing the way things are done, changing the way things are looked at. We can point out some of the, the experiences we've had and how things have gone well. Really, we're always trying to, as a group, we work with our clients, really to try and figure out what went well, what didn't, right, and address that, adapt to that, modify behaviours for future products or future service lines. So we'll touch on that at the end as we wrap things up. And with that, I'm going to hand over to Bernard. Bernard's going to speak about the data recovery effort post-breach and talk about the expenses that can entail and measuring those. And then we'll move on to business income after that. So Bernard.
Okay, thanks, Simon. So Bernard Regan, principal at Baker Tilly. I'm not a forensic accountant like Simon and Harriet. I'm a forensic technologist. So my background is digital forensic and investigations. So I concentrate on the costs relating to the restoration, investigation and mitigation of a cyber event. So over the next few slides, and Harriet can go to the next one, please. I'll just touch on that subject and just discuss a few things that we see, not only when we're trying to understand the event, but also, looking at the reasons why we are brought in to assist, brokers, insurers, and the insurers as well, to try and help everybody understand what happened, because it's not very clear from a pure technical bits and bytes point to all the way through to a business language. So we often work as translators on that piece as well. So on the slide, I've done a slide on cyber wordings. The rules of the game, if you want to call it that, or the words of the policy, is it's normally looking at if a cost that was being incurred was reasonable and necessary. There's lots of discussion around that because at the moment, given that the cyber market is still relatively young, is still trying to work out what we need to do in terms of the costs that have been incurred because of the event. There's often this disconnect between just because a cyber event has happened, every single cost that has been incurred by the business is attributable to that event, and therefore should be covered by the insurance policy. That's one way of looking at it. What we have to look at is to make sure that those costs do arise from the cyber incident itself, and it's a reasonable cost that has been incurred to help with the restoration piece of the network as well. So, we have to think about things such as betterment, enhancements of services and offerings and software solutions and hardware. So, we have to look at that as well. So, the second one is looking at, there's obviously instances where older machines, older hardware, or some software that was once running is no longer available. So you have to look at, say, Windows 7, for instance, which is now obsolete and not covered in support from Microsoft. If you have an event, we have to look at the costs associated with restoring that environment, not back to Windows 7, but possibly Windows 8 or Windows 10. So again, it's not trying to catch anybody out. It's just making sure that the costs that are coming through on the claim is making sense to begin with, and then also working with the insurers to make sure it fits within the policy language. Next slide, please, Harriet. So this is almost the process that I advise people to take, and feel free to use this and pass it on to your IT departments. One of the things I have often discussed with corporations is a document called a Cyber Incident Response Plan. Excuse me. Just like a disaster recovery plan, just like a business continuity plan, a cyber incident response plan will actually detail what you need to do in the event of one of these cyber events. It doesn't sound anything different to what the BCP and the DR are doing, but you have to be thinking about this from a ground up exercise, because some of these cyber events do completely wipe you out. So for instance, a malware attack. We have cases at the moment where there's tens of thousands of computers and thousands of servers that are being completely encrypted. The plan in the disaster recovery is to go to backups, restore from backups, and you'd hopefully be good. The problem is that these malware often go out and find the backups first, encrypt them, and then encrypt the rest of the network. So you have to be thinking about instances where you don't have backups anymore. You have to go back to other principles, or you look for other alternatives like tape backups, for instance, where it's off-site and located outside of the network, that can be used to restore both applications and infrastructure as well. Excuse me. This slide is also giving you a flavor of what you should be doing in terms of recovering from an event. So as a business, when you've suffered an attack, you should be looking at your applications and looking at the servers which is being used to generate your revenue for your company. Don't focus your attention on the peripheral services and servers and applications and computers. Think about your business as an entity, and think about your business trying to get money back in through the door. Harriet and Simon will talk about the business interruption and business income loss later on, and the two go together. So on a cyber case, you typically see the three of us working together. The other thing to think about is having things in place to help with restoration of PCs is key. If you can have a centralized application which is running that, and you can restore that and push it back out, that's obviously going to be a lot quicker and a lot more efficient than having to touch every single machine and rebuilding them from scratch. So again, think about how you're going to recover. And I'm not putting this solely on the IT teams or the IT departments. This is a business approach. You need to have the key stakeholders in that room having these discussions, because when a crisis happens, everybody is going to be shouting at IT to fix stuff. And it's unfair just to say it's an IT problem. It's a business problem, and it's everybody should be involved in trying to figure out what we need to be done. Next slide, please, Harriet. So again, this is just emphasizing the slide before. This is what I'll be typically using as a state of play, if you like, for figuring out what the costs have been incurred for. So I work in the storytelling world in terms of a beginning, a middle, and the end. The beginning is looking at the background, the event itself, looking at the incident response reports, looking at the malware strain, and understanding from a business aspect what was taken down and what's the implication of that. I then need to know from that investigation what vendors you've brought in, what activities have you done to restore and get yourself back up and running. And then the end of the story is tying it all together with the invoice support. So if, for instance, in a lot of cases we deal with that middle piece, the statements of work, description of tasks, the understanding of why vendors have come in and assisted you, we're often missing that piece. So what we typically have is a background and the invoices. So if you imagine, sometimes we have invoices for multiple millions of dollars. So an invoice comes in for $3 million, say. I can't tell what they've done. So you can see quite quickly that we need to have that middle piece in order to understand what it relates to. So I can then explain that to the insurance carriers. We will then also look for any other documentation in support of replacement of hardware, replacement of software. If you've got master service agreements in place, then we need to think about what they are and what support you have from them, and any expedited costs that result from that as well. And then the last thing on the slide is quantum, and that's where I take all of this technical information and timeline and feed it into the accountants to be able to work out what the business income loss is. Next slide, Harriet. So these are the common headings that we see in the insurance policies. Hardware and software are quite self-explanatory. The consulting costs can be anything from new third parties, where you're bringing vendors in, or they can be the vendor panel, which is on your cyber insurance policy. If I could give some advice free, it would be, if you suffer an event, reach out to the insurance carrier as quickly as possible, because the vendors on that panel know and have the experience of dealing with the event you're suffering. Bringing in a vendor who doesn't have cyber experience is often challenging, because they won't know how to deal with it as succinctly as other vendors, and often they'll be concentrating on the wrong thing in terms of getting your business up and running. So just have a bit of caution around that. Looking at IT staff, as I mentioned just a moment ago, the IT team will be pushed for fixing stuff, and you have a lot of pressure. You'll have the C-suite or the governing boards saying, just fix it, I don't care what it costs, just get me up and running. So again, there's sometimes initiatives around bonuses and overtime and all that good stuff, which Harriet and Simon will cover as well. Next slide, please, Harriet. And then I put this in just a bit of a talking point, really. So over the last 18 months, we've been seeing something terms as bricking, and it used to be a standalone endorsement where you could pay an additional premium for this cover. And the idea behind it is if you suffer an attack where the hardware is rendered as unusable or in a state where it can't be repaired, then the idea was that it could be used to quickly replace all of the affected machinery. The problem is with this, it's not clear every time because all of the wordings change in each of the policies. So you have interchangeable words. So sometimes it will be unusable, which is a very broad term. Sometimes it doesn't say anything other than it's rendered useless. Again, you have to be careful about that language because with most PCs on the market today, most of the malware strains, which could take you down in encryption, you can format the hard drives or pop the hard drive out and put a new one in, and then just reinstall the application or the operating system back onto it. So again, it's in there to help you recover as quickly as possible. But as I said, when you start reading these policies, make sure the language in there is questioned by yourselves and the brokers and NFP on this as well, just to make sure it's giving you the protection that you need. And as it mentions at the bottom, this is typically for laptops, computers, servers, software licenses as well. And we're now seeing this in industrial control systems, which again, you have to think about things such as SCADA systems. If you have old legacy systems on your network, think about how it's going to be impacted if you have a cyber event. So if that machine or that system was physically switched off and it could never be switched back on, what's your backup plan? Because some of these systems are 20, 25 years old, and you can't just pop down to the local store and grab a software application to replace it. So you have to be thinking about these before the event happens. Next slide, please, Harriet. So I think I'm just going to hand over to Harriet now, who's going to start talking about the business income loss. So over to you, Harriet.
Great, thanks Bernard, and hi everyone. As Bernard said, my name's Harriet Bateman. I am based here in our New York office. I've been dealing with business income loss claims now for about 8 years, and over the past, I think, nearly 5 years now, cyber business income loss has become more or less all I deal with all day, every day. So can certainly offer some insight today about how we go about those calculations and the types of things we're looking at when we're performing those. So on this first slide, what I've put together is just an overview of the policy wording. I'm not going to read it all because it's long and boring, but we can talk about some of the key things that we're looking at, when it comes to business income loss calculation, and what things that you should know that your policy provides, and things that you should be aware of probably before an event happens. The three key things that we look for is the wording around business income loss, which we will talk about in a second. Also extra expenses, which are going to be those costs that come through, again we'll talk about, and then the period of restoration, and that's the period essentially that you're covered for the business income loss and extra expenses. So again, I'll talk about those individually, but just to make you aware sort of those three key terms. So in terms of business income loss, we use the phrase business income and business interruption loss sort of interchangeably in the insurance market. They are alluding to the same thing, which is basically the loss of profit that you've suffered. So under an insurance policy, what you're insuring with business income loss is your profit and loss statement, and that's the sort of the key thing. We're not insuring cash flow, we're not insuring your balance sheet, we're insuring that profit and loss statement, and that is what we're measuring as well, any change in that resulting from an incident after a loss occurs. There are sort of different phrases that we see on insurance policies as to what's covered. Most of them mean the same thing, I'll say that. They just treat it in different ways in terms of how they describe it. It's definitely something you should explore with your broker, but I've put on a screen a very typical example of one that we see, and that's any net profit plus your fixed costs, and we're measuring any change in that. And if you think of net profit plus fixed costs as basically the same as your gross profit, then that we're measuring that change, which I'll come on to then. And then the rest of the detail on that essentially just talks about the fact that what we're trying to do is measure what would have happened but for the incident, and we're trying to exclude and isolate any other impact, so any other factors that have affected the business during the loss event. So might be economic conditions, anything else that would have impacted the business. We're trying to factor that into the calculation and ensure that that's not included within that bottom loss figure. And then just a bit of wording on the extra expense. That's again normally a bit more simple in terms of the wording, but there are variations on that, and that is basically measuring any incremental costs. So costs that continue that then increase as a result of the incident, we're capturing that incremental portion. And the variations in wording that we see around those, sometimes it has to be incurred to minimise an interruption, so that the period that your systems are down. Other times what we're looking at is that it would be incurred to minimise your loss of revenue, so it can be linked to different things, but again it normally comes back down to have you incurred a cost that's over and above a cost that you would have normally incurred. I think in terms of the slides, this is a fairly critical slide, and we'll spend a bit of time here just looking at what this is. This is a very, very simple profit and loss statement, and this is essentially what we're doing when we're doing a business income loss calculation. We're looking at what your expected position would have been during the period that you were down, or the period that you have cover for, what you actually did, so your actual business achievement, and then that will translate into that movement in profit, which is then your business income loss. So, but for the incident, what would the business have achieved? What did they actually achieve? And then that delta is what we're trying to capture. And if we're looking at a profit and loss statement and we're trying to measure the things that have changed because of the incident, I think this is a good, simple way to look at it, because what we're looking at is, okay, let's start at the top. Has your revenue fallen as a result of the incident? So the incident happens. Was there a drop? And then what was that drop? But we look at the drop by predicting what would have happened, during that time if the incident hadn't occurred. And we'll talk about some of the things, the things that we look at in a second when we're trying to predict what the revenue would have been. But that's ultimately what our goal is, to then compare that to what you actually did. The variable cost savings, that's basically what we're factoring in there, is the fact that if you don't sell a product, and there might be a possibility that you've saved costs against that. So just to make it really simple, if it's an online shop, for example, that doesn't sell a coat or a jacket, is there a cost associated with that product that you've actually managed to save? So we have to take that into account and factor that in. So your loss would become then, the loss of revenue, but reducing it for the saved costs that you've achieved against that. And then in terms of your fixed costs, so this is something that sometimes can cause a bit of confusion with insureds, but your fixed costs are really exactly that. They are fixed, they don't change, and they are unlikely to change, especially in a cyber interruption where you have a fairly short period of interruption. So typically we don't see that there's been any change in that, and by paying the loss of gross profit that a business suffers, what that allows a business to do is pay their fixed costs as they normally would. So I think, the key takeaway, again, Simon said it earlier, you can get into the weeds on a business income loss calculation, but the key thing really is, and this is what I always try to, remind insureds of on day one when we're talking about the kind of things we want to look at in a calculation, are, these two things. Have you lost revenue as a result of the incident, and how are we going to measure that if you have? And then have you suffered an increase in your costs? And then how are we going to measure that if you have? And those two things lead to what is typically insured under your policy, which is that loss of profit. So moving on to sort of the first factor that I talked about was that loss of revenue. And, when we're trying to project what the revenue would have been, but for the incident, what we're doing is we're looking at different things that are impacting a business at different times. So if you think about all the different types of businesses, there is significant differences in projections that happen during a certain time period. In this instance, I've just set out monthly turnover of a retail store that had extremely high sales in December. It was a business that was really driven by its seasonality. So obviously when we're looking at a loss calculation, if we're calculating a loss in, say, May, that would look very different to if we're calculating a loss later on in, say, December. And that would be factored into our projection. So we'd say, okay, last year in December, what did you do? And what would you have done in this December? And then we might reduce that or increase it for any business trends. So in terms of the projection that we're making, we're really looking at, okay, how is the business performing in the lead up to the incident, and what happened when you have the interruption, and then how does that look in terms of recovery after that. So that's what we're capturing, is those three specific periods: the performance beforehand, which we use to measure the performance during the incident, and then the subsequent recovery. And I think, with cyber interruption, what becomes really key is, because in cyber interruption, you're really talking about being down for a number of days or weeks rather than months. Sometimes at a monthly level, the calculation is just too hard to see the true impact. So, you might have varying business performance in the months leading up, and then what we really need to do is dig down to the daily level to see the extent to which a business was impacted at a daily level, like I say. So in this, for example, you'll see a chart of daily revenue. Again, it would depend on what day of the week the loss falls. So, for example, if it falls on a Saturday when there's a peak in sales, that would look very differently to a loss that fell on a Monday. And again, this depends on the length of interruption and how long we're measuring a loss for. But just a sort of high-level thing to bear in mind, your loss might look very different depending on the day of the week that it falls. And I think I touched on this earlier, but in terms of variable costs, what we need to capture within that is a lot of insureds make the error of presenting a claim to their insurer based on pure revenue loss. And one thing we have to discuss with them quite often is, okay, because you've lost this revenue, there are things that you will have likely saved as a result. And I've captured a couple of key ones on there, just so you have that to sort of trigger your memory in future. So material costs, that comes into play, in retail, in manufacturing, and anything where you're selling a product. Selling costs and commissions, that's more common in sort of agencies and things where you achieve a commission, or you have to pay your staff commission on selling a certain product. Or freight, we see freight all the time. If you're not shipping a product, you're not having to pay the freight costs associated with that, and we have to capture that within the calculation. And normally it's normally quite simple. You can take it as a percentage of your revenue, or you can compare your costs that you expected to have to pay out on a certain level of revenue and compare them before and after the loss, and that would be essentially how you calculate your saving that you need to reduce your loss of revenue by. And then, so coming on to extra expenses, I've listed some things that we most commonly see in cyber interruption, and by far the most common one is overtime. So, if you've gone down for a period of time and then you continue to pay your staff throughout that time, but after you come back online, you have to then pay people additional amounts to catch up on that sort of a loss of productivity during that downtime. Any additional labour costs that you're incurring, you're then able to pass on to the insurer as an extra expense. So what we're not talking about here is salaries and other normal payroll costs. Again, this comes up all the time. There's an assumption sort of if you're down for a period of time and your salaries are continuing because your workers have not been productive, there's an assumption that you can claim for your salaries. But instead, what business income loss looks at is what was the result of those people not being able to work and being unproductive. And that's when we come on to capture that loss of revenue, the loss of gross profit, which allows you to pay that normal salary cost out in a way that you would have been able to if the incident hadn't occurred. And then looking at sort of other extra expenses that we see. So outsourcing is a pretty big one. So if you can't make a product yourself because you've got downtime, but if there's an ability to outsource some of that production, you can go ahead, spend that money, and that will save you some money and the sort of the loss of revenue. So it's always something that insurers are, happy to pick up as long as it's, economic and making sense in terms of the other areas of the claim. Same with, logistics and any other increased costs that we review. Ones we've seen recently include sort of increased audit costs. These are ones that, are typically a little bit more difficult for insurers to make an opinion on, and it's something that it's always beneficial to get sort of real-time feedback from insurers as to whether there's something that's going to be covered before you go ahead and pay something, and then they say, hang on a minute, this isn't covered under the policy. So I think, in summary, there are some extra expenses that are much more easy to validate and sort of have insurers accept coverage on than others. And I would just always make sure that you're keeping your insurer appraised of everything that's happening along the way, and that makes everybody's life easy, in terms of getting real-time feedback from them as to whether something, an extra expense is going to be paid under your policy. And then in terms of your period of restoration, this again becomes key because it's essentially the period of time that we're looking at the measurement for. So different policies have different periods of time that they cover. Very common wording is for you to be covered for the period of restoration being the period that you're down, basically. And then obviously there's some subjectivity to that because we're often asked, and this is part of Bernard's review, okay, what does it mean for a business to be restored? Bernard, I don't know if you can offer some sort of input just in terms of what you see on that side.
Yeah, of course. And it's an interesting question because there's multiple thought processes that need to be taken into consideration. So just because you're up and running from a revenue perspective or a business operating as usual, and if you could see me, you'd see me doing the bunny ears in the air, it doesn't mean that you're fully restored. So in these times of crisis, you often see companies taking the opportunity to, get rid of a lot of legacy systems because they just don't need them anymore and they don't have to be rebuilt. But it's one of those instances where just because the lights are on and they're blinking doesn't mean you're restored, because it's not just the infrastructure, it's the data side as well. So we've seen multiple instances where the server infrastructure and computers have to be restored, and then it could take a couple of days to actually get the restoration of the data into a state where it can actually be used by the business. So the restored piece is a huge question, and it varies from case to case.
Perfect, thank you. Yeah, and I think, one thing we wanted to touch on as well, because I'm sure it'll be important to everybody on this call, is factors to consider when you're thinking about your sums insured. So the amount of coverage to buy under your policy. And, the key things that we recommend people think about is what does your daily revenue look like? What's at risk? So if you were down for a certain period of time, and you can sort of run scenarios against that. So if you were down for a week, if you were down for 2 weeks or 3 weeks, imagine being down at your peak time. What would that daily revenue figure look like? And then reduce that by your saved variable expenses, which is the same thing as what's on this slide, your rate of gross profit. And that would give you an idea, a very high level idea of sort of the most profit that you would be losing on a daily basis. I would say that there are other things to consider in terms of, I've got other factors on there, such as are sales delayed or lost. So in some businesses, there's much more of an ability to, for example, say to customers, okay, we're down, bear with us, your product will be with you in 2 weeks. Other businesses are much more reliant on everything being done on an urgent basis. Again, it depends on, if you've got customers who are on contract and they're going to continue paying even though you're down for a period of time, then your business is probably less subject to revenue losses, maybe more subject to increased costs. Say if you have to incur some additional costs in sort of keeping customers happy and making sure that you're able to provide all the necessary services after the restoration. Bernard, do you want to talk about infrastructure on that slide?
Yep, sorry, I was speaking to myself on mute. So again, it comes down to lots of questions that we need to find answered. So, size of business, locations, countries, they all have impacts on the way that the business is operating. So just because, again, as I mentioned just a moment ago, just because the HQ is up and running doesn't mean that all of the satellite offices or the other locations are up and running as well. So we have to be thinking about, the business as a complete unit rather than just maybe 10 distinct units as well. So again, it comes into having this cyber incident response plan, because you have to think about that when a company goes down and you do have satellite offices, or you have other locations across the globe, it's going to affect them as well. So you need to be setting out things such as manual workarounds. You have to be thinking about the restoration piece. You have to think about, okay, well, if these 10 locations go down as well, what does that mean from a business continuity point? And the bottom point, backups, again, each individual site may have their own backup procedure and their own backup policy. So again, you have to make sure this is all documented, and it just goes to the point where you need to be doing a lot more upfront work rather than just sitting back and hoping and praying that you don't get a cyber incident.
Perfect. Sounds good. Okay. I'm going to run through just quickly at very high level some of the key issues that we see in a few different sectors. I won't spend too much time on this. I just wanted to give you sort of an example of some of the things that we see. So with manufacturing, the losses vary in size significantly, and the main reason that drives this is the fact that some businesses carry inventory and others don't. So if you think about what you're covered for, typically under a cyber policy is the period of time that you're down. So if you're down for, say, 2 weeks and you're able to continue and maintain some of that revenue during that 2-week period, then your loss is likely going to be much smaller than if, for example, you're a business that doesn't carry any inventory at all, you custom build everything, you have no ability after you've restored to catch up on any of that lost production. That's going to be a very different looking loss. One thing I talked about then was overtime. Again, some businesses have much more of a capability to flex their labour force and, more ability to say, okay, right, guys, come and work an extra few shifts. Whereas others, are at complete capacity, they work around the clock 24/7. And so, if they're down, that's it. They're going to lose that production as a whole. In terms of professional services, I'm talking here about, lawyers, accountants, architects, even some construction companies as well. What we see in this instance is that places are either they've got a fixed fee or an hourly rate that they charge, and that can lead to very different looking losses as well. So with a fixed fee, if you think about a fixed fee, your revenue will continue as normal. So your revenue is really not going to be hit. What might be hit is your costs. So you might have to incur some additional costs after you've restored, again, to catch up on some of that downtime. But I think really we see smaller losses in places like lawyers and accountants for really the nature of the work. If for example we were down tomorrow, Baker Tilly, and then I had a week without access to my systems, probably what that would mean is the week after I would have to catch up on some of that work that I was unable to do. That's not going to cost my business any more money because I'm a salaried employee, but they're still going to achieve that revenue. So overall, that loss to them is probably going to be much smaller than if you're, for example, a manufacturing unit that loses for every widget that you're unable to produce, you're losing the sale of that. And then finally, software providers, that's something that we've seen a lot over the last year, and there's sometimes some difficulties in measuring a business income loss. Software providers often have customers who are on fixed term contracts. So if you think about what's covered under your policy, you're covering your profit loss during a defined period of time. Excuse me. What that means is if you go down, your customers are stuck on their contracts, but they may decide to terminate those contracts after your period of cover under your policy is up. So you have this loss that then falls outside of your period of cover. So that's definitely something that I would suggest bearing in mind when you're purchasing an insurance policy. It's when am I likely to suffer that loss? Is it going to be immediately afterwards, or is it going to be later down the line? In which case, that's something that should be reflected in the period that you're purchasing.
Harriet, if I may, Simon, just jumping in here. There's a Q&A window on the Zoom facility, so any of the audience can throw questions in there. I was going to invite that in a moment. There's actually a question already in there that talks about what you just mentioned, really. It's what's happening when long-term clients sort of either lose faith in their service provider or cancel a contract. And as you just described, the traditional cover is very much geared towards a time limitation, 60, 30, 90 days longer, whatever that might look like as a period of restoration. But I know from your experience we had, and I think you just touched on it then, we have seen, haven't we, those situations where, customers just walk away because of the cyber event, either because they've had enough, and it's not acceptable, or they can't afford not to. In other words, they have to get the supply of the product they need, so they have to go and find another contract. And yeah, that's something that's, I think, caused the insureds a little bit of surprise, because what they're saying is, oh, look, this client left and my client is probably worth to me, $500,000 over 2 years. And they just walked away because of this event. And yet they're discovering that the period of restoration is a 90-day limitation. So I think, as you mentioned there, the best advice probably is to have that conversation with insurers and make sure it's understood what that period of restoration really means. In terms of a loss, that if it's a client or a service industry that might walk away and see, contracts cancelled or long-term loss, but then only be looking at coverage that's much shorter in terms of a period.
Simon, I think this is over to you anyway. For you going to talk
perfect
about
timing. Yeah, sorry, I'm misplaced where we were in the conversation. Okay, thanks, Harriet. Just a reminder, there's a chat box, or it's a Q&A button on the Zoom feature. So if there are some questions that, from anything you've heard so far, that you want to put up there, we can start to tick those off. Part 3 here. I wanted to bring us all sort of together, myself, Harriet, and Bernard, and really we've talked a lot about the sort of conceptual approach to loss measurement in the post-breach, post-cyber breach situations. Just to wrap things up here, I wanted to talk a little bit about some experiences, really. And I think, as an insurance policy holder, the success of holding that policy is certainly measured on how it responded and reacted in the case of an event. And, being quite honest, there are situations that we get involved with that go very well, and then there are those that don't. And so I think we're just touching here as we wrap up on some things that that we think about a lot as a team. We see some of the frustrations in the claims process. We work with clients to kind of communicate those frustrations and see if there's things that we can do to assist, and change things. If you want to move on to the next slide for me, Harriet, if you could. The list we pulled together was just some talking points, really. One of the things that we see and experience quite a lot is, at what point does the sort of loss measurement commence? At what point do we start having the conversations about the financial damages? It's pretty easy to spot at what point the restoration needs to start. I mean, that's immediate. But as far as sort of getting into the discussion of what the financial damages look like, there's a question out there as to when that should happen, and different carriers have a different response. So that's something to sort of keep in mind. What's their plan and process in terms of the financial damages after an event? Bernard mentioned it earlier. I think the insurance sector has done, in this particular sector, I think they've done a fantastic job over the last 5 to 10 years of making experts available. I don't know, in terms of the audience, the scale of the businesses that you work for. I'm sure it crosses big, small, and then some in the middle there. And so each business is going to have a different philosophy on whether it needs or doesn't need assistance, right? The big companies perhaps typically are saying they don't, and the smaller companies are saying they do. So the insurance programs have certainly responded to that and tried to make sure that there is assistance out there, vendors that have been approved and vetted, that know what they're doing. And Bernard mentioned it. They know what they're doing. They've done this a lot. They can assist in the response. And they're companies that ultimately the insurance companies are comfortable with. And so you bring in a vendor that isn't on one of those lists, and it sort of throws a surprise into the mix in terms of the claims protocol and process, and changes the dynamic a little bit. So just something we've seen. I think it's worked very well. And like I say, and Bernard will agree, especially in the restoration area, these companies do in fact now, with just the number of cyber incidents we've seen out there, they do know their stuff very well. Something we're starting to see and get involved with ourselves a bit more is the pre-risk review. So considering what the business does, how it does it. We've heard Harriet talk about just kind of understanding the revenue flow, and what's the revenue made up? What does it look like, right? Is it created? It's very different from manufacturing, financial services, retail. We certainly see the same event impacting those three industries have a different impact in terms of when the loss exists and what it looks like. And I might actually call on you, Harriet, if you could, just sharing maybe the experience we see quite a lot, especially in manufacturing, where perhaps that loss appears to be avoided in the early phases because of the use of inventory or outsourcing, but does in fact perhaps manifest itself later on in, let's say, the annual life cycle, when there's a need to rebuild inventory levels or restore, the business model back to how it was.
Yeah, totally. I mean, I think I touched on it before briefly, but I can talk about it in a little more detail. I think, with manufacturing, I know in property policies, for example, there's a bit more history with, different policies being written specifically for manufacturing businesses. In cyber, the main cover that is available is really relating to, again, just that measurement of profit loss during a defined period, and that would be the period that you're down plus the number of days. What we're finding with manufacturing is that under many circumstances, there is, for example, inventory to carry you through that initial period to maintain your sales, but then that leads to a loss, say, at the end of the year, the financial year, where you then have to replenish that inventory and it costs you more money. But by then you've exhausted that period of cover that you have available to you. So again, these are just things to focus your discussions on with your insurers when you're buying policies. I think, if you're, like I said before, if you're a manufacturer who goes down and that leads to an immediate sales loss because you don't have any ability to flex your labour force or to use inventory, then that's a very different looking loss, and that would be captured very easily within the loss of sales and loss of profit measurement in the period of restoration, being the period that your systems are interrupted.
Thanks, Harriet. Yeah. So, I mean, the pre-risk review, I think we see there's some value in that. Each company looks at it differently. They can maybe handle that themselves and maybe they can't. And so that's something that the insurance sector is starting to make available, just to give people a bit of comfort as to what that loss might look like in the event of a hypothetical cyber event. And there's a whole host of hypothetical events we can draw on from the past real events that we've seen. So the next two bullets really talk about the sort of claims experience itself. Cyber's been very innovative. I already mentioned that in terms of the vendors they make available and the service providers to assist. But I think we've also seen and been part of some innovation in terms of the claims process itself. For those that have experienced claims in this sector or other sectors, there's certainly the traditional approach where it's very much, the insured develops their loss model, presents it to the insurance company retains somebody to review that loss model, and they come full circle and ask a lot of questions. And that's, quite a back and forth process. Some of the innovations we've seen have sort of led to a speedier claims resolution, really focused on more of a collaborative approach to developing the damages model. So the insurance company isn't just sitting back and waiting for the delivery of the damages, but actually getting involved or getting accounting firms involved like ourselves during that process to sort of say, okay, we're going to assist and guide that insured business through the process, kind of hold their hand and get to a place where, look, there's a BI damage loss, there's an extra expense damage loss, and we've reviewed the restoration expenses. We're in a good place. They've been validated. We consider them accurate and reasonable, and now really that claim can be resolved. So just something new we're seeing more often in this cyber world. I think it's just because of the innovation that exists. It's not necessarily being adopted in the more traditional insurance products, property, marine, and others like that. We're always sort of looking around as we get involved in these claims, and I mentioned it before, we work with clients constantly trying to improve things. So when we're involved in a claim, we take a look back at it frequently and sort of figure out what went really well and what didn't, and how can we adjust the process, and we share that with clients so that they can do that themselves. Overall, sort of, if you can move on to the next slide, Harriet, I've got just a snapshot of, I think, the benefits of some of what we're describing, really, that shift in preparation and readiness for the attitude towards being ready to deal with a cyber claim, not only from the restoration effort perspective, but extending that just a little bit further to understand what it means financially, and really understanding what you will need to do financially to document and support the damages that you feel you've suffered as a result of an event. And it's a pretty simple graphic. It's, traditionally, we're on the bottom, really, not so much preparation and a fairly lengthy timetable to initiate the claim review, establish the measurement concepts and processes, understand the policy language, understand who's going to be involved, a lot of back and forth, and then final settlement of claim. The top line is, I think, where we can easily get to with a little bit of readiness and preparation on the front end. And I'm really focused, as an accountant, I'm focused on that damages piece. Is there work we can do collectively to make sure that in the event, when that event happens, there's actually less to do to finalize that damages model, because we've done quite a bit of the work up front. And it can be simple things that take time. It's crazy but understandable, but just getting NDAs in place can mean that timeline from event to finalization suddenly drags and drifts along, because you can't get the various parties involved in the process to sort of get on the same page legally in terms of what's going to be happening. So things like that we can always look into before the claim has even happened, and consider whether there's some scope to prepare for some of that before the event happens. Onto the next slide. It's just again another visual to try and pinpoint our philosophy on cyber damages. Really, is to be involved before, during, and after different phases of the process, doing different things. I've talked about the before. I think there's things that can be done there that even if it's just education, so that the policyholder is fully aware of how this thing will go down when the event happens and what the financial model will need to look like. Then assistance through the process, through the panels that are made available through the policies, and then follow that up with some feedback. I think feedback is often missed, but I think our team has got a philosophy of always trying to look back and kind of think about what went well and what didn't. So I think at that we've got a slide that sort of wraps things up with really opening it up now to questions. If I'll check that box in case there's anything else in there. Alyssa, I think you had a comment that you wanted to bring up, and I may be putting you on the spot, but
not at all. Thanks so much. Wanted to wait. Yeah, thank you guys so much. That was great and super informative. And we do have a question that's timely, because I was going to mention it earlier with respect to a company experiencing a business interruption loss and potentially losing business as a result of that reputation and customer distrust. So this question about reputational losses, how is that quantified beyond what was discussed today? It's a really good question, because the reputational harm, quote unquote, adverse publicity coverage is something that has been added onto the cyber policies probably in the last 3 years or so. It's at this point kind of a throw on, and the question is correct. The quantification that goes into that calculation is essentially the same as if it would be a straight business interruption loss. And that being said, it likely we would involve Baker Tilly or a firm such as that if there is a reputational loss. Unfortunately, there are very few, if any, claims or losses in the straight reputational loss space, so it's a little tough to say kind of how those have looked, but hypothetically, the calculation would essentially be the same because typically the reputation loss is going to have to stem from a cyber-related incident, and most likely that would be involving a business interruption loss. So it's very similar. One other point I wanted to touch on was the typical hourly waiting periods that are addressed on the cyber policies. Because there's kind of a misnomer that this is historically a property damage cover when you hear business interruption on the cyber policy, obviously the perils are going to be different, being, typical denial of service attacks or ransomware being, the most common way that we're seeing these claims coming in now. And with the cyber insurance market hardening the way it has, you're no longer seeing waiting periods of 6 or 8 hours. Now, pretty commonly, these are 10 to 12 hours. That's kind of what you're seeing. So after 10 or 12 hours of you being a company being down, that's when the cyber liability insurance policy would kick in to, bring in a firm such as Baker Tilly to kind of help you figure out what has been lost, quantify those extra expenses and, ideally work to get you back up and running. But again, those are some of the losses. One other thing I wanted to touch on quickly was, as Simon talked about, this pre-risk review. A lot of cyber carriers right now over the last couple of years are providing, in addition to just a cyber policy that responds when you have an incident, a lot of proactive services. And if they don't provide some services for free, typically they'll provide some discounted rates to help you, conduct this pre-risk review and or just help you understand what your hourly loss would be if there was some sort of incident. And ideally knowing kind of what your recovery time objective is. That's kind of a standard question now on applications, especially if you're looking for business interruption coverage, which is, one of the integral parts of the cyber policy. So just touch on that. We do have one more question. We have a couple minutes left, so I'll just answer this one. The question is, are bricking limits typically limited to analysis to improve systems, or is coverage being made available to cover the cost to purchase and implement improved systems? That's a really good question. That's now known as quote unquote betterment coverage. So this was up until I'd say 6 months ago, not at all provided. The standard was, we'll provide the cost to get you back up to the level that you were before the interruption happened, but we're not going to provide costs to get you to a better level than you were before. Now, frankly, what we're seeing a lot of times, that's just not the case, because if that operating system no longer exists and there's 2 above it and you just happen to be working on an older system, it's not feasible to try and get you back up to an outdated system in the first place. So you are seeing that this coverage is included, and it will be typically to include the betterment coverage. Of course, it depends on the carrier, it depends on the language, but bricking limits also, they are typically sub-limited. What that means is if you have a $10 million aggregate limit of liability, you may not have the full 10 million for a bricked device. There is improving coverage in that. Some carriers are willing to do 50%. Some carriers are willing to do the full limit. So something to keep in mind. So with those questions being answered, I would like to, again, just thank Bernard, Harriet, and Simon for that very informative presentation. To encourage anyone on the call, if they have any questions about cyber liability coverage, any questions about proactive services and any dedicated resources, please feel free to reach out to myself. If you have questions that you didn't think of now that weren't answered, please feel free to reach out to me or Harriet or Simon or Bernard directly, and hopefully we can get you the answers that you need. Just a reminder, there will be a recording of today's presentation available in 48 hours. And with that, we're going to close it out and say thanks, everybody.
A pleasure.
Thanks,
Thank
everyone.
you.
Thanks for having us.
Yeah, thank you.
Thank you.
Thanks.